Hello, hello, hello. Welcome back to FOMC Day. Today is Wednesday, October 29th, just 2 days before the end of the week, end of the month. Before Meta, Microsoft, Google earnings reports. 30 minutes before the Chairman Powell press conference. 2 days before PCE. One day before Amazon and Apple earnings. All right. I came back to the market maybe like one period ago. All right, FOMC, what happened? What is the decision? What is the decision? What was the decision? I don't have anything here. This is very quiet. Very, very quiet. The decision is out. Now notice these highs here, 3 highs. Now we have 4 highs, 2 up here. This little thing does not repair these ones. Let me open it here so I can see better. You know, setting from all-time highs. This kind of shapes here, you can see kind of like this is pushing to the downside. Notice how many times this market attempts to break, right? Boom, I pull back. Second time is pull back. Third time is pull back. 4, 5, 6, 8 times. No, I don't know how many times. 3. Try to go lower, and each time is pulled back to what is now POC. And there was a cut, 25 base points. Therefore, that was a forecast. And the market has already priced that cut. And traders were pricing 3 cuts until the end of the year. And that one has been cut to only 2 cuts. If that doesn't happen, what can happen here? We still have 3 more months to go. For some reason, this is not opening. What color is this? Let's do it blue, right? Alright, like that. What's that? What is this? This is value. Unless the market has a significant upside or downside, value is going to remain higher, right? What it is right now. Depending on what Chairman Powell says, we may see some volatility here. And expect the unexpected here. All these texts that are reporting after the close, to me it seems like it is already pricing. If anything, they will need some room to go. Technicians. See this kind of formations here. This kind of formation as a area, right? as a time, as a no man's land. There's just the volatility is expanding here, expanding there. I have done absolutely nothing here. I took my time to actually take a nap. Let's take a look at Nasdaq. Look at this, man. What is happening to the ES in the upper side? It's happening to Nasdaq in the lower side. These are divergent markets. ES is trading inside previous day range. Nasdaq is barely holding above previous day range. Russell is inside with a short covering pattern, which weakens the market. Same goes to the Dow that is already developing inside previous day range. Let's see here, right? Here, remember this formation here, this one, let's see. Remember this one? This area here. This is tremendous weakness that is here, but the market has not, it doesn't have the power here, the conviction to even repair this low here. By doing so, it's leaving absolutely mechanical traders dominating the session here. And I think it looks like relevant traders are out of this market. Maybe waiting, I don't know, maybe waiting for Chairman Powell to do something, which I think is going to be just very, very short time frame trading, and probably waiting until earnings are out. Oh, look at this. Look at this, what do you have here? 35, where is 35 here? 35, is this one? This one? Yeah. And that is 14, that's right now. It's happening right now. Happening right now in J. Marker, where's my marker in J? Here, right? Here, right here, we got something here. We actually have two. Huh. Is this positioning? I'm talking about this. I'm talking about these blocks here. Right where it is right now. Here. Now what I am seeing here, for example, is kind of like a range. No, this is not a clear pattern like going higher, going lower. It's boom, trying to, what can I say, this maybe holding a line here? Don't know. Don't know yet. Look at this, man. Bottom is still lower and lower. Look at that, man. Look at that. Look at that. You know, it has moved from this area to it's aiming now this high. This high here. Let's move this one over here acknowledge, okay? This is no excess here. There's no excess. Oops. But you got the idea. No excess here. What do we do here? I am moving my chart, my volume. What? I have two charts here? What the heck? What the heck is this? Well, no wonder why I have so many channels open. Okay. I'm going to move this to the side. This is in one corner, lower corner, so it is all visible. Right at the center, man. Right at the center of that pattern, that formation. Notice one thing. I want to just remember what happened. I'm going to. This is what I am following. This is very clear in the background, okay, of my mind now. Okay. What was this? Oh, this was actually this is the spike here. This is the spike here. Why is it relevant? Actually, it's not. But that's a spike, and all of that happened above this spike, okay, which is a sign that the market is accepting higher prices. Let's minimize that. Let's expand this profile here, okay, and check this POC, where POC is. For example, POC is right at the center of the profile, between the high and the low. And POC, if there's another period here that starts trending lower and reaches this area here, POC is going to remain there. It's very unlikely for POC to move lower now. And why is POC is important? Because it's an area where weight trade can take place. Now look at the shape of this. Now this area is holding potentially target. Even if this node of volume is reached here, this market is still to the upside. And this will shake, right? This will actually correct some of the weaknesses that this day has had, which is this area here. What is that? 69.24? Yeah, this area here, right with this volume. So what I'm trying to say is that what is holding all the inventory we have now is a really weak base, right? But sometimes markets just keep doing what they do, keep going higher in this case, regardless of what is the support below it, what is supporting or what is holding the market. And to break the tendency, to break the trend, sometimes an exogenous event has to happen. Like we had a couple of weeks ago with Trump saying that there is going to be 200% tariffs on China. Now something may come from that meeting as well. Well, all right, let's see now. Let's see if that 24, 26 area can hold again. I'm not doing anything here. Alright, we are at the lower side of this pattern here. But you got the idea here. I don't like to have these things here actually. It could be misleading. Notice the volume. No, in the current period, volume is already higher than the trend, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Right? To reach yesterday's volume, there has to be tremendous amount of trading here. 6,800. I mean 600,000 so far. Let's see what happens. It has to go from here all the way up to here. Look at what it is. This thing has to keep running. We are half into this period, so if the pace continues, half is right here, right? Another half will be double this, would be around this high. Kind of. This tremendous change here. Will it happen? No idea. Oh, look at Meta, man. This is post for a big upside here. Microsoft, same thing. Gosh, man, it's very dangerous here to be short in a short time. This can go higher really easily. Google. Yeah, I guess Google is a toss here. Apple. Yeah, same thing. Same thing. Oh, look at this range in Apple. Oh no, this is in the intraday. This is 10 minutes. No, don't care about this. Man, this chart, these bonds are charts look really bad. Look at this. The heck is this? This can go higher. Wow, this is a nice axis gold has here. Yeah, maybe trying to reach the 50. Okay. Notice what is. I mean, I can see 3,000 here, right? So there's no conviction here, man. In this market, this seems like it's trying to check this. I mean, trying to shake the weak loans that came in here yesterday. You know, and this one is checked. The next thing that the market can do is maybe check this, the high of the spike. And we have in between, we have this distribution close, we have POC, this support. Let's see, support now. Support area. But this market just doesn't have any kind of conviction. The next thing I'm going to check here, I guess the next thing here is Chairman Powell, what he has to say. This is, I have this as a pop-up window in the corner on my screen, on this main screen. You know, every once in a while I have some kind of things, right? When the market has, and this is the only website I have. I have it here. Oh, I cannot see. You know, here in the corner there's a little pop-up window. This is my, what is this? My start bar on the PC, right? Every time, for example, the market has some really fast downside movement, and I don't know what the heck is going on, maybe after 10, 15 seconds, something comes up here, right? You know, and what that is this new, you know, if I go to the website, this is Financial Juice. I go to the website, I will find this. You can also go to Discord. But usually what I need is just a pop-up window there, right? I also I don't listen to news constantly, all the time there. I don't do that. I use the link of the Federal Reserve at 2:30. We'll see here Chairman Powell coming. Yes, 5 more minutes. Zero choice using. I don't like when it. Well, 16 is. I don't think 64 is that bad. And what I will do now. Let me check this one out. You can come here now, just for now. As a matter of fact, I am going to keep it on the right side. I don't care about that. We still have like 4 more minutes. It doesn't seem like this is going to reach that, but it is on its way. It is on its way. Maybe it may come down here. The next period, which is when Chairman Powell speaks, we may see, we actually may have something there. No, this is quite a thing, quite a day here in this market. We may see something like this in the next period. Well, let's see. It doesn't mean anything, right? But by itself, it really doesn't do anything. So, meaning that I do not trade based on volume, right? But when I trade, I check volume. It's more like that is more like a piece of information that I keep in mind and gradually stack one over another one day over another one over another one, and it is a set of days. What happened during a range of days that can lead to something, right? For example, if I see an upside or downside, a strong upside or strong downside, and I don't see volume coming, that means that movement is, it's not being backed by the market. Well, by the participant that make the market, right? This is hollow. It is a hollow movement. If anything goes unplanned, or if something derails, it can derail. It can go fast, really fast in the opposite direction. Whatever the direction is. Oh, oh, look at this. I didn't check Nasdaq here. Look at what happened with Nasdaq. Look at this, huh? Oh, look at it. Oh, wow, look, Nasdaq looks more interesting here. There's no excess here. I mean, what we have in Nasdaq in the lower side is what we have in ES at the upper side. This is just very tricky situation here. Very tricky situation. Okay, Chairman Powell is here. I'm going to put Chairman Powell here and observe how the market reacts to what Chairman Powell says. All right, here it goes.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggest that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown
A 1/4
showed that
percentage.
growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities
Stop
and
filled.
currency keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risk.
framed last month and maybe today, I won't put words in your mouth, as a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, and we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percentage of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing continue to come down. So if you remember,
this is another time that this is happening. I am noticing this is, when the market has these big breaks, I mean, yeah, I have been checking this. There's a consistency here. Consistently, the market has been attracting huge amount of volumes when it has these big breaks, regardless of where the market is. The market can be high or low or middle or doing whatever, but when there is some sort of movement to the downside, or if I look for if I check high increments on volume, when the market attracts high volume, usually is when there's a directional movement to the downside. And it has been consistent in the past, I would say, months, that there is something going on here, really. So there is something going on here. What happened is these kind of movements, this is the other thing that I have observed, these kind of movements don't have continuation, right? So there's some push, some big push that comes to the market, like boom, what are these? I can say that's positioning, I can say there's some rebalancing. I don't know what's going on. I will never know that. But it's something that you're observing that happens with very consistently.
The stubborn services inflation that you
Right now, this market, just check what it is. Well, let me hold back here. If the next period prints a high right there and continues lower, those kind of advances, in this case, if it happens to the downside, have the tendency to not to be a lasting one. And all the weakness that we were talking that this market had yesterday, the previous day, had been checked, right? But it's left here, and it happens that we had tremendous amount of volume here in this day here. That volume was not overcome. It just stayed there. The market didn't went through that. It stays there. It make a stand here. the next downside, the next potential reference in the downside was maybe the center of the gap, or maybe this high, extremely high volume here, right? As we can see, the market is just doing its thing. It's just crushing the shorts now. It's just killing the shorts now. And squeezing the shorts, squeezing the hell out of the shorts here now. It came back right, notice where it's selling from now, right from half back. Not half back of the period, but half back of the day. This high, I don't like this high either here. So we have another one here maybe, right there. Can you see? Right there, right where it is right now. Okay. Oh, another thing is I was just looking at this market when this was going higher. This was obvious at the time. Right? I was saying, wait a minute, because I checked this high here. Yeah, maybe this is where it's going. But then I noticed, wait a minute, this just white here. And what happened next? Absolutely nothing there. Absolutely nothing there. And what happened? There's no way to know, thinking that, I should have been short here. Man, forget about that, man. Nobody can do that. Really, nobody can do that. At least nobody that I know, right? Because what happened here after, it happened so fast, man. Like in 10. Whoa. And the volatility was high there. And something that I mentioned, this was weird actually that was going on here with the VIX. But it was weird that this market was going higher. Actually, it was going higher, and the VIX was going higher as well. You make a low of 15 something, and it was in 1660, something like that. As the market keeps going higher, and I don't see that often, right? And the people is getting, each time is this there's more sophistication here in this market. The put call ratio was also increasing here. That was weird too. That was weird. All right, the market is making a stand here around. I can see halfbacks, but this kind of support that came from this high, that's another thing, right? There is something there behind that is giving more validity to these references here. Right now, I consider this level to be support. Right where the market is now, support or resistance. And when the markets are trending, have a clear direction, this kind of movements are seen as an opportunity actually to go, to go long in this case, right? After all, look at what we have here. 1, 2, 3, 4. This high side, this J period doesn't remove the stops here. After all, this was a 45 to the downside. This is a 45 was coming back. Market was being pulled back up, coming back. Market pulled back up. To POC. And this movement actually, this market may come. Man, this market may come. I'm not saying that's going to happen, right? But maybe around this area even. It seems now, but trade the market that you have in front of you, not the market that you think you will have, right? Now we have a 3-day range. That support line that we have there has been taken. This low is holding, so this is a 3-day range right now. The market slide the center, and guess what? What do we have after the close? Earnings, right? So this can go lower or can go back high. Let's keep listening to Chairman Powell.
Implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that
Regarding trading, the area where the market maker stand is this little one here, right? That the one, this area that didn't have anything there, from which everything started, right? There's a weak base here. The same thing that we have here. Whites, absolutely whites in NASDAQ, but this is NASDAQ. This is another market, right? But kind of, but the similarities are obvious here, right? The retracement in NASDAQ is impressive. It's back into this range, coming back inside here, targets this, actually may target this high here. This is not good, man. This is not good. Oh, look at this. Look at this. Volume is coming up here. Volume is coming up here. This is an unfinished action here. What's happening here? This formation, oh boy, I don't like this. I don't like this. But okay, we may be seeing something here. Okay, now they are buying profile, but this is not good. This is no good. What the heck do I do here? Huh? You don't have to do anything, man. This is really hard. Let's keep listening to Chairman Powell.
see whether there really are downside risks to the labor market, or see whether, in fact, the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last two meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. And again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a a big policy change that actually began in the last administration, and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that
Order
does
filled.
its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year?
And this has been a while there at the close. And the thing is, if you were trading, for example, if you were trading here up until 2 p.m., probably by now you're exhausted, man. I really, expended a lot of mental capital here. I am watching now. I'm watching when this press conference ends, so there can be something here. Maybe because the market is back inside previous is back inside previous range, and that can target this high here. Nasdaq, I have taken previous day high out, can target maybe this area here. Okay, but I will look maybe to buy some deep here. I already did a micro longing in Nasdaq. I won't touch minis here. The risk is just too high, man. Just too high. This markets can move against you really fast.
You can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices.
In the ES, what I'm looking, okay, in the ES, what I'm looking is closing at the distributions here. Both markets are doing the same at the same time. The same reference. Closing this distribution, taking this high out. There might be something to the downside after that, and that can be seen, but may coincide with the end of the press conference, and there can be something out of that.
Feel better over time.
It looks like I am looking for a trade here.
Michael Bickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or
I was checking this unfinished auction, which now has been checked out, right? It has been repaired. This has been repaired. I would consider. I have my doubts though. It doesn't look like it dies here. It dies here. It may need to come down again to find more buyers here if it's going to try again.
In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. Again, I'm not, it's not appropriate.
Continuation may see has the distribution clause, taking several fees and then distribution clause.
By lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different in the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing. Growth, actually, growth as opposed to level. Consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
VIX is still 17. That's below 20.
Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you
Look at the volume, man. We were talking about the some unbelievable volume that came here in this period, in this during this break, right? This big break here. Now with this follows 14 is here. It may end up here, right? So that will put this market around here, right? 1.3, some 1.2, 1.3 millions. You can see the divergency. Now they are on pair now. Volume is volume, the market overall volume are both same. Now, there is some important thing here. If there is something here, something serious, this market will close below this low here. Right? Closing below this low, sign of sign of weakness. Right? It is true. It is going to be true that that will leave a non-excess high. Non-excess high. This would be the second time the market does that. It did it here, non-excess, but notice we have 1, 2, 3, 4, 5, 6, 7 highs. Now it is a kind of like a double top. Traders have a tendency to see this as a good opportunity to sell, but there is no excess at the high. This market has no excess. More likely to be, to pull prices higher. This kind of highs don't have a tendency to be lasting ones. We have weakness in the lower side. This period low around the 6,900, the period high around 0. The most important thing, again, when it closes at the end, and if has the ability to close the distributions here, and for Nasdaq taking previously range high out.
And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story. It's kind of stable. So you don't see anything that says job market in really any part of the economy is significant. Or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
that we're
section
thinking
of
of?
the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo.
Last question.
Loans given delinquencies in subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. And you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
And that was it. All right, let's see what we have now for these markets here. So German power is down. Let's see this one closes this distribution here, and especially where it closes relative to yesterday's range. It's very tough area. I mean, very tough area here. This was a trade here. I didn't do anything there. What the heck is this? All right. This is, I mean, the area where the market is right now is right at the center, right half back, right this high here. Maybe the next period may use, trading wise, may use this reference, but I see this like a really dangerous area to place anything here. But again, I see we may have something here actually. I haven't seen this. This one can check this, can put some volume up here.
Order filled. Order filled.
Not really, this it's very dangerous zone here. I mean, it would be something the market maybe would have been down here, right? Or maybe above value. But it's right at the center, man. Right at the center of the range, right at support, resistance. And here you can find yourself, caught in the chop of the market. Two minutes before AM. There was this low here is another opening yesterday. The low here is a 6,900. Oh, and guess what, right? What do you have after the close? You have earnings, right? now this market has a room actually. Now this market has room to go higher. Right? Now it has room to go higher. There's tremendous amount of short covering that has been in progress in the last 30, 45 minutes here. No, but it also has room to the downside. Probably the center of this gap here, or maybe in Nasdaq targeting, maybe repairing this or closing this gap here. The high is not good for Nasdaq. Just imagine this. Just check this out, right? This is stops here, right? It stops here. It stops above this area here as well. Right? But when the market does this movement, it really doesn't have, and it doesn't have volume. to hit. If those stops would have been hit hard, I would have seen a spike there, some quick upside there, like boom. It didn't happen. It rather grinds way higher for this market, for Nasdaq. The ES is different. I find out that most traders most retail like Nasdaq. If you trade Nasdaq, I am very interested in knowing why. Okay. All right, look at where it has opened. Right below value. They're selling from value. There's obviously there's value here. Let's say looking at value, it has something. It has some volume there as well, so there could be something there. Let's see if these whites are filled. The auction to the upside has not been completed here. The selling just dry here. This was a virulent reaction to that press conference, man. Right from the opening, almost. Look at this. Is this the center of this period? Yeah. This doesn't have good odds here. You know? What is Cedar? Cedar is down here. Nasdaq has its Cedar around 160. So that Nasdaq is positive. The ES is not. Exactly 163 actually. I'll go 159 here. Yeah, you have the idea. Or have the idea there. All indices now are to the downside. No. I want to take those words back. Russell is to the downside, the Dow's to the downside, ES is an inside. Probably. I'm going to check. Still want to check where it closes, right? That's my main thing, where it closes. If it closes below or above. That can be useful information. Nasdaq is at the highs. With some questionable low in here, some questionable low down here as well. Okay, Nasdaq has excess. Nasdaq has an all-time high. With excess, right? This thing's not working. Why is it not working? Okay, whatever. That's an all-time high. It has excess. All right, this low is being checked now. It's coming down. Some weakness here around the 6,900. No, man, there's nothing here. I thought there was going to be something here, but I don't see anything here. Very tough market to trade here. Very tough. Very tough market. What happened here? Why are you coming back? Is there a way to I didn't know there's a way to call back. Huh. There's a way to call back, erase it. Huh. Didn't know that. No, this doesn't happen.
Order filled.
Let's take this movement. Let's see how far it goes.
Stop
Okay. I am not willing to give anything to this market. I guess I'm so too nervous here. Yeah, really. Clearly, I don't want to give anything to this thing here. I consider here that is basically the day is over here, right? You know, I was short here, but I really just looking to or aiming, looking to just correct this low, being at the 6,900, right? Kind of like the same thing that happened here in Nasdaq, in which the market just corrected this questionable low that has coming coming right from L back. And notice what's happening here now. We have a big range, big ass range bar here. Now we have an inside bar, and now we have an inside bar also forming here. Right? This market is in balance. The range. Do you remember what we had here before? Do you remember what we have here? This formation here. Now is the opposite. Right now we have something different. I mean, not here, but in this market, right? Knock this. This range is contracting here. So there can be something of significance coming out of this. But again, the day is over. We may see a spike here, but being the last period of the day, it will depend on what the market does tomorrow, or maybe after the close, because we have earnings here, right? This is not coincidence. This is not coincidence that the market how this market is setting for the earnings. But this market may come back to the center here, and await somewhere in here. Value is higher. After all this movement, value still is higher. Notice it's overlapping higher. Not high, but overlapping higher. Alright, guys, I hope you had a wonderful day. I hope you have wonderful rest of the day. I wish you a good day. See you another